Today's episode is in partnership with Big Red Cloud, a leader in accounting software. So it's time to get rid of the Excel spreadsheets and switch over to smart accounting. Hello and welcome back to Boardroom Insights with Alan O'Neill. The best intentions for any organisation is to be successful, to grow. But of course there is a reality, and that is that some organisations fall into distress. The indicator of that, of course, tends to be the financials in the first place, but it can be other things driven by market forces or even sometimes mismanagement, which is sometimes a reality. Today we're joined by David Fleming from a fledgling organisation called KR8, and let's hear from David and his take on the restructuring industry and what's going on there. David, you're very welcome. Thanks for joining me.
Thank you, Alan.
So David, KR8, who is KR8 and what do you do?
So KR8 Advisory, we're a restructuring advisory practice focused very much upon turnaround. So we go into businesses typically that have had an element of distress. That could be one-off issues like a bad debt, or it could be more imminent issues like cash flow forecast problems, where the business needs more money and needs to go through potentially some sort of restructuring, but our focus is on saving businesses and finding solvent outcomes.
Right, of course, the outcome, we'll come to that, but in the first place, you mentioned bad debt being one example of a driver, but that just sounds like a one-off thing to me, or could it be more than that is driving in?
Yeah, it could be many things. You'll appreciate COVID was a big one-off event that we became quite busy speaking to and helping businesses during that time, but being a bad debt being another example. But ultimately there could be a downturn in trading. So the company's registering losses on a annual or monthly basis, and it needs some kind of change within the business in order to prevent ultimately what would be an insolvency. So we tend to go in and try and understand where the business is and what the options are that the management can consider.
Who calls you in the first place, David?
Probably 50-50. 50% will be lenders. So that might be a bank, asset-based lender, debt funds, credit funds, where they've lent money into the business and there's been a covenant breach or a covenant trigger, or trading deteriorates and the need to get people like us in. And probably the other half will be other professionals and advisors. So that could be lawyers, accountants, maybe direct to corporate. So we have CFOs, managing directors, CEO, chairman, non-execs that sit on boards, and any other professionals working with businesses. So they've probably already been involved or are seeing some issues in the business, and they will typically look for a financial advisor like ourselves.
And do you find, David, that the companies themselves, if you're called in by a lender, for example, because they're getting itchy, they're getting nervous about whatever's happening, and maybe they've missed a repayment or something, but they know there's an issue. But do you find that when you go into the companies that they're aware? If they're getting a knock on the door that they weren't expecting, I'm sure it doesn't come from you, it comes from the lender, but do they tend to be aware at that stage?
It's a mix, really. I think the larger, more sophisticated boards probably are fully aware of the situation of where the company is in and will be working with the bank, and the bank will have gone to see, or the lender will have gone to see the management team, talk through why they've got issues, and the management team should be well on top of anything like missing payments and the cash flow, etc. So I think you have the more sophisticated management teams will be aware. To what extent and how bad they think it is may be differing between maybe ourselves and maybe the lender and other stakeholders. Then you do have some instances where we meet management teams who don't think there's so much of an issue, and really it's our work that probably highlights maybe it's more serious than the management team think, or maybe their management accountant or financial controller hasn't properly given the data as to the potential outcomes in the future of if it's running out of cash or whatnot. It may have been a bit late. So it very much depends on the management team.
But is it always driven by visibility on the cash situation, whether it be cash flow or annual accounts or something? Is it always related to money?
Pretty much so. It might be trade deteriorating, which that would trigger some covenant maybe with the bank or the lender.
Yeah.
So at that point in time, the whole reason for these the covenants are an early warning system for the banks and the lenders to say there is a potential issue with the business. Cash is king. Cash is a main driver. So again, I would say that when the management team, the forecasting, or the management accountant is doing the annual forecast or short-term forecast, if it looks like it needs more funding or there's pinch points in the future, again, that's the early warning signs for us to potentially get involved.
So if we take the early warning signs as an example, the motor industry right now today, we know any motors that are manufactured outside of the US, we know there's now a 25% tariff for going into the US. So any of the English trophy brands that are likely now to be hit badly by that. Do you find that the lenders will be obviously reading the tea leaves around that kind of stuff? Will they preempt that this is going to cause a problem and send you in before it becomes a cash problem, or do they wait for the cash to become the issue?
No, very much they will be fully aware of their exposure to the automotive industry. That's not just to the actual OEMs and the brands, but the full supply chain. So
yeah.
I'm sure after, very topical as we talked about before we sat down, the tariffs on cars going into the US, I'm sure they're going to make an impact on sales for some brands, maybe not for others. There'll be an impact on strategy for the OEMs. Do they go and actually manufacture over in the US as opposed to export to them?
Yeah.
And they'll be looking at what the impact is to their business, margins, order book, etc., and that will hit up the full supply chain. So there'll be no doubt many people, and it's not just lenders, it's key stakeholders in the business, that could be private equity, and anyone with investment into that supply chain as well, that will have concerns about what does the future look like if indeed the tariffs bite and we're in a new world of trade wars.
Sure. But David, when you go into an organisation, obviously you're not going in there to close it down. You're going in there to try and help them to turn around, I guess. So what does it look like? So what happens from the time you land? The appointment has been made for Tuesday morning, 9 o'clock, you arrive. Just talk me through the steps.
Yeah, so very much we'll go in, try to explain, who we are, what we do, very much focusing upon, we want a solvent solution, we want the turnaround. Myself, I'm not an insolvency practitioner, whilst within KR8 we do have IPs. We very much are, turnaround focused accountants, I would say.
Yeah.
So when we go in, we explain who we are. One of the first things we look for, that's two things I suppose, is one, have we got an underlying viable business? Now there's no doubt some more work to be done on that, and that might be part of the business is losing money, what's making money, have we invested in certain areas of business that are underperforming, do we have subsidiaries that are dragging down the wider group, etc. And secondly, it very much is, well, what does the cash flow look like, what's the cash runway look like, how long have we got, and then how much do we need? Once you've kind of got that will take some work to get to an understanding on all of them points, but once you have that, you can start to look at the options for the business.
So your presence, I guess, starts with an IBR, an independent business review?
Yeah, I would say nowadays the IBR is absolutely right. Spent many years and I did a secondment within a bank where I ended up reading pages and pages of IBRs. I think the focus more certainly with KR8, and the market has slightly moved, is we shorter form reports, getting to the core problems of the business and getting an understanding on what the strategy is, risks are, and where we go forward. So very much we'll be pulling together documents for, be that banks, ABLs, private equity or other stakeholders, and that will be based upon us doing a lot of work on the numbers, getting under the skin of it, and then pull together.
So you've done your desk work before you arrive, I guess, at the client.
Yes.
So when you go in there, then it's you're well armed with the information and the data.
Yeah, before we go out, we always want to, we can do our own checks, we can do searches as and when needed on company's house, but we'll always ask the client before we get there, can you give us as much information that you're comfortable providing prior to us coming out, just to get us up the curve and understand. We may even have an initial call that might give us just some more detail on what the issues are, and that might just help how the meeting goes when we get out on site.
Sure. I'm curious, David, about the emotions and the psychology of all of this. That when you arrive, the reality is it's a distress situation. So people are not feeling very good either about themselves or about the business, and particularly if it's a family company where there's a lot of history and emotion tied up in that. Whereas I suspect with a larger corporate, the CFO is, with respect, that bit removed and can be a bit more clinical about the reality. But what do you encounter when you do arrive in terms of the emotions and the people element?
Yeah, a mix. I mean, it's a very good point. Family businesses could have been in the family for years. It might have people in the family working within the business, so It's very emotive and very, very close to home, really. So I think you do end up with different people as you arrive. Some people are more emotional about where they are and can be more difficult to bring round, if that's the right term. And you do have other people who are more clinical, so they understand where they are, less emotive about the business, and just want to get a plan and deliver it, really. So I think one of the skills really in turnaround is that empathy when you go into the room when you're meeting boards, is to have an understanding that to them it's what they do every day of the week, and they've put a lot of time and effort into the business, and nobody wants to see it fail. So there's definitely a lot of emotion involved.
Do you find defensiveness?
Yes, absolutely. Yeah.
Sure, yeah.
There is very much that. I think people don't like to find themselves in difficult positions, and everyone would like to deal with it themselves and not have to bring in people like ourselves and other professionals. So you do end up with sometimes a defensive board or director.
Yeah.
But again, it's just part of the work that we do and part of the journey that you work with the board on.
But if you take a family company, David, where there's just a pending reality that you see it, you just know whether it's because of the industry they're in, or when you're taking a look at the books and they're just not facing up. It means the dead horse is there, but there's nobody talking about it. I mean, have you come across those situations where, and again, families particularly, are just won't let go? Yeah,
very much so. So, coming off the back of the Ep.3 point, I think the balance is you have to be direct and honest. You need to. We're there to give professional advice. We're there to try to ensure everybody understands the position the business is in, the severity, and what might happen if we don't act. So there's definitely an element where you do need to ensure that everybody is coming from the same page, and that allows us all to form a plan and get behind a plan, and try and work the way through whatever situation they find themselves in.
Yeah, I mean, burning cash is burning cash. I mean, if somebody, they may well have assets backing up what they've got, but if there's just no future. But your empathy, you're strong on this point about empathy. You've made it a couple of times. But tell me, what are you seeing in terms of trends then? COVID you mentioned already at the start of this chat, but what kind of trends are you seeing in your world right now? Will it be industry trends or economic trends, whatever?
Yeah, I think more recently we've had a lot of directors and lenders call where they've got exposure to hospitality. So with the increase in employers NI and the increase in minimum wage, these for multi-site businesses really do hit the profit and the underlying cash. So we're having discussions with businesses in that sector. I think that the minimum wage and the employers NI will impact any business where we've got multiple sites and employees where you're on that minimum wage point. So maybe care homes and recruitment, temporary recruitment, where you're having to push through the increases onto companies, and ultimately that drives inflation, and inflation is a problem that the UK is currently grappling with. So I would say they're the sectors we've seen a lot in construction, but that seems to be a common theme, which has been for many years.
Is that just in this country?
Yes, very much so. So very much UK focused, but we're very much sector agnostic. So we see all different sectors across the board, really, and they all have different challenges and different reasons that we're seeing them. Yeah,
sure. But hospitality, I get it. The capital outlay is one thing, and then the repayment of debt is what it is. But are you seeing that because hospitality is trending from a revenue point of view down, or is revenue still keeping up, but it's the costs particularly that are
very much cost. I think
right.
what they're seeing is revenue flat, but costs increasing. So the issue for them is the worry about passing on costs that will result in a fall in revenue because people don't want to spend the money or disposable income. So the focus is very much around the increasing costs that they're trying to bear and the inability to then pass them on to their customers.
Yeah. And I guess, does this tend to be a lot of B2C companies where they're highly labour intensive? Retail, hospitality particularly. I mean, they tend to have a high payroll cost. So the national insurance and the minimum wage increases, for example. I mean, are you seeing that trend particularly in B2C? Yeah,
very much so.
Yeah.
Okay.
Right. I'm just thinking then about if you talk us through an example, David, I'd love to know about an example of where you've gone in and as a result of your intervention, the company turned around back into positive territory. Yeah. And then let's talk about one that maybe didn't quite work out and try to get underneath the bonnet as to what caused the differences if we can.
Yeah, so a good example is one that I wouldn't say is out of the woods, but a company that I worked with probably 18 months ago. They had 2 frauds, so they were in the aerospace sector, supply chain into the large OEMs, had 2 frauds, one ironically with an IT manager and one with the financial controller.
Internal fraud?
Both internal. So I took a call I can remember it on a Thursday, midday. I was on a train Thursday afternoon and met the board on Thursday evening. Didn't know the full extent, but I suspect that had you dug deeper and gone further back, you're probably talking 7 figures. So it's a serious fraud from both the IT and the...
Were they working together?
Yeah, yes, they were, yeah. Right. So long story around the fraud, but we came in, first thing we did was they didn't really have a great handle on the numbers or a plan really, because they didn't really have a good view of what might happen over the next 2 to 3 months. So we dropped in an interim CFO, so somebody who'd worked with for many years, somebody with a lot of experience of turnaround and managing cash flow in difficult situations. So we managed to get a good view from him of what the immediate cash needs were and what levers can we pull to mitigate any cash requirement. We contacted HMRC, who had a big VAT bill due, and they had a pay-as-you-earn payment, and we spoke to HMRC to manage them payments over an extended period of time that gave us a bit more headroom in the cash. The lender, we spoke to the lender pretty much immediately after meeting the board to say that there's an issue, we want to work with the bank. They were fine and supportive, but we managed to refinance to another lender that managed to release more cash. So we managed to just kind of conserve cash and create some working capital for the business. Yeah. We helped recruit a financial controller, more senior than the existing finance team. We introduced lawyers to the business to deal with the fraud and litigate. And ultimately, we got the turnaround done. So it isn't out the woods. These things don't change overnight. But
it takes time, yeah. But it's working through in the right way.
Very much so, yeah. So I speak to the client quite regularly, and the order book is okay. Sales are coming through. They are very good now on cash flow forecasting and cash management.
Right.
And we've also introduced them to private equity, who have a appetite in that aerospace space, and maybe that's something that might happen in the future. So lots of options, lots of levers were pulled. But it was a great example of a turnaround of going in day one without a plan, without really a handle on what the future looks like and what the cash is.
And David, just a segue for a second, just a linked point. I mean, I remember during COVID I heard some statistic that organisations were caught out for not having enough cash. I mean, there was an average, did I hear a number something like UK-based organisations had an average of 2 months of cash only.
Okay. Yeah.
And I don't know how true that is, but I mean, was that an issue at the time of COVID where not having enough cash was a problem?
Yeah, I think so. I think the holding cash, I understand the point, COVID, you can't really plan for something as severe.
So extreme.
Even the best businesses found themselves in scenarios that you would never really ever plan or envisage for. I think what COVID probably has resulted in is management team being more resilient around having cash reserves for things that may happen in the future, as opposed to running businesses on tight working capital and investing all the time and reinvesting. So there might be a change in mindset, but yeah, I can understand the COVID, the pandemic.
I mean, it was extreme.
Yeah, it's very extreme.
So let's go back again then to the other example, unfortunately a more negative one, where you went in, did what you do, but it didn't turn out in terms of a turnaround.
So I think, a good, there's something I'm working on at the moment that may well end up not being the best outcome, and 85% of the businesses that come into us tend to be a turnaround and a nurse back to good health and go off into the future, hopefully never needing to call us again. Certainly not for turnaround experience and work. But we've got a business where came into us, I would say, late, so very short cash runway, and because of that, I think part of the group will need to go through an insolvency, which is a shame. But we will be able to save probably 2/3 of the business, partly overseas, which is good. But so again, what I would say is, had we been in 8 weeks ago, we would have had a good run at saving that part of the entity. But I think now it's just too far gone and too late.
So early intervention is critical then, David?
Absolutely, yeah. It makes a huge difference. It's between a successful turnaround and a poor outcome. Without a shadow of a doubt is time. Early the better.
So David, when you go in, again I'm thinking about when you go in, you're focused on numbers, essentially. But tell me, in my thinking, the numbers are the score of the game. They're lagging indicators of whatever has gone on. These are the numbers, and in this case, they're not good. But of course, we know that there's lots of drivers. There's other elements of the business that caused that situation. And I'm wondering, to what extent do you get involved in looking at other elements of the business that might be, whether it be structure, whether it be product mix, whether it be route to market, supply chain, blah, blah, blah. That's not your expertise, I appreciate, but where does that come into the equation for you?
Yeah, we do. We're very sector agnostic, so we've worked over many years, and the team have across all markets and all sectors, so we do have a good underlying understanding of most of the businesses that we see. But what we will be speaking to the directors about is not just the numbers, but what are the kind of key underlying drivers, the KPIs. We'll go through them with the management team, but also we'll chat through, like you said, product mix. Hopefully the business we go into, the managing director and the board should have a good understanding, a clear understanding of where they make the money, where they don't make the money, where the issues are. And if that is product mix, for example, and they might have moved into different SKUs or different products that aren't profitable, then we'll help them do that analysis around almost supporting their view. We'll get under the detail and the numbers to basically back up what they are saying and make sure that what they're telling us is right and it is the right thing to do, which might be to stop or to sell part of the business or to stop manufacturing certain products or trying to get out of potential contracts that are loss making. So there's lots of things. So we do get much. It's not just a pure numbers game. I would say we can't really do the turnaround without having a deeper understanding. So whilst the numbers drive an awful lot of the turnaround and information flow, that be to lenders, what their exposure looks like today, next month, next year, etc. We'll be in the background doing a lot of work with the management team and the finance team around getting behind the underlying data. And also understanding all the sensitivities around the numbers that they produce for us.
Sure, but of course the best intentions of people inside the boardroom are to do the right thing and for the business to be a success, but things can go wrong. And one of them being the leadership team itself, whether the structure is not quite right or whether they're not getting on very well. There's tensions, there's politics, there's other culture issues. Do you get near those things?
Yeah, very much. I mean, certainly if we're our lender, funder side, the lender may well ask, whilst you're doing your work, you'll be spending a lot of time with the directors or the finance director, finance team, the board. They might ask us to give us our opinion on how the board are working. Are they working well together? Have they got a strong CFO, FD, financial controller, the right structure in place?
Yeah.
So we can always help and assist and make our own judgment. I think in the turnaround that I talked to you about, we dropped in an interim CFO into that business. So we can help, I'm not going to say strengthen the board, but we can bring people in that have the expertise that will support the board. And if we do have issues where we do believe there's a need for change, we're more than happy to have that discussion with the kind of key stakeholder, be that the funder. And we've had difficult conversations with businesses where bad decisions have resulted in the business being into an element of distress, and sometimes it does need new leadership.
Do you see some finger pointing going on? I mean, obviously, if for example, if you've identified that the issue has been something in the strategy, whether it be the route to market or the supply chain, I mean, individuals own those parts of business. Yeah,
there is sometimes, I wouldn't say all the time, often the boards accept the responsibility is the board, and if it's if they're meeting on a monthly basis and regularly, then they all make the decisions. It tends to be old FDs, so FDs leave, new FD comes in. There was a problem, that's probably why the FD left, and then there'll be a load of finger pointing at the old FD. The numbers weren't good, the numbers weren't right, wasn't doing this right, wasn't doing that right. So there is some of that, which you typically find in turnarounds, but it's not wholesale, I would say.
Yeah, sure. So is there any advice that you would give to companies out there that maybe are feeling something is not quite right, then it hasn't happened yet that they've had you guys or your equivalent called in, but they know themselves instinctively that there is something not quite right? Is there any piece of advice you give to them?
Yeah, I think probably the biggest piece of advice is to get people like us in early.
So back to your point, early intervention.
We can get in very quickly, and we do this as our day job, so we can pretty quickly get up to speed, give our opinions and help the businesses. So the sooner the better. Sometimes we go into businesses, we aren't engaged, we're not doing a reporting for any particular stakeholder, we're just almost hand-holding through a process whilst we get up to speed. Often it might not be as severe as they think, which is great, and we can step away and do a much kind of higher level support function, if you like.
Very good.
Or help them with, again, bringing in the right people around them if they haven't, if there's a reason that they've not seen this coming, or the numbers weren't right or weren't issued right time. We can start to point them in the right direction of, well, you might want to strengthen part of your team.
Great, okay. Well, look, on that positive note, let's take a break, and when we come back, I'd like to just know a bit more about KR8 and indeed yourself, and how did you come to be doing what you're doing? So back after this. Introducing the KR 7+ Index, the ultimate organisation health assessment. This is built on solid research. The assessment delivers clear insights, data and benchmarks on what truly drives success. The KR 7 steps to profit are common sense. But here's the reality. Common sense isn't always common practice. Leaders know what they should do, but their best intentions often get diluted before reaching the front line and eventually your customers. That's where the KR 7+ Index comes in, because it cuts through the noise, identifies priorities, and gives you the proof and stimulus to act with confidence. This isn't just another survey. It's a game-changing tool, blending cutting-edge AI, robust research, and expert consulting, all to turn insights into action. So, no more guesswork, just clarity and results. Please visit 7plusindex.com to start your journey to better business health today. Thank you very much for listening, and please do hit the subscribe button or leave a review for wherever you're listening to this podcast. Thank you. Welcome back, David. So, when I was planning this chat with you, I was telling some guys that I was meeting you, and I got an interesting question, and I thought I'd just bring this up and get your thoughts on it, and I'll give you my own thoughts too. One of them is in order to maybe prevent the day coming where distress is looming and before anybody calls anybody, what are the things that organizations could and should be doing to execute and more effectively so that they don't get into this distressful situation? And my first response to that is, well, it has to start with the planning in the first place. So if there's good quality planning, strategic planning in the first place, and where that plan is being updated, I mean, many companies, for example, do a 3 or 5 year plan. Then they leave it there, they never look at it again until the end of the 3 or 5 year plan, which I don't agree with. Nor am I saying you should be redoing a 3 year plan every year, but I am saying that you should do a rolling 3 year plan. So let's say you develop your 3 year plan, but annually then you check in, because the world is changing all the time. And if you don't check in on that plan and tweak it accordingly, you're missing a trick. And I wonder to what extent that might be part of this problem. So to me, quality planning has got to prevail. But then, of course, governance of that plan. And I don't just mean the annual check-in, but if there is good governance, and I'm talking meetings here, good quarterly, monthly, weekly reviews where we're checking in on the plan is detailed, and we're checking in on the plan, we're seeing the early warning signs up front. That coupled with a good quality risk register. Now that'd be my take on how to execute effectively. But for you, because I know you're in the world of distress and helping, but you also care that companies succeed. So what advice would you give to organizations to prevent themselves falling into distress?
Yeah, I think I agree with that. I think everybody starts with a business plan, and that spits out the numbers, spits out the cash flows and the balance sheets. I agree, the world changes so quickly now and so rapidly that plans can change, and simply running a 3 year plan and then checking in 12 months later, you might have missed the opportunity to catch any issues in the business that may happen. So agree, definitely a monthly check-in, and the reason people have monthly board meetings are exactly for that. What I would say is that the cash flow forecasting should be regularly revisited, and if you have any deviation, especially on the downside from the original business plan, be that through margin, profit, sales, contract wins, etc.
Call it out.
Yeah, absolutely. Or even working capital. So if the debtors aren't paying and creditors are starting to apply pressure,
right,
and the cash flow isn't where you thought it was, stuff like that's really key. And I'd also probably add into that mix is that when you're looking at your plan day one, you should sensitise that plan for key risks that you identify in your business. So if you have it's dependent upon certain contract wins, and you just take out some of them contract assumptions going forward, or if there's delays in landing a contract or delays in starting a contract, then what does that do to the overall business? What does it do to the P&L? What does it do to the balance sheet? And ultimately, what does that do to the cash flow? So,
are you seeing companies, with effective risk registers? Obviously the large corporates too, I know that. I mean, it's part of their governance and so on. But what are smaller companies? Are smaller companies taking the risk register seriously?
We see less and less as the business is smaller. I completely agree with you. The larger businesses are much more focused upon that risk side of the business and what impact certain things may have to it. But definitely in the mid-market and the certainly lower SME side, no. I think their approach to risk is less sophisticated. So they're not looking always at things that could impact the business in a negative way. However, what I would say is that the management teams and people that are experienced within their industry, they are aware of it.
Yeah. And I mean, I know there are many leaders out there, they almost feel, well, look, that's being negative. But I don't believe it's being negative. I think by being negative at that planning stage, it's being positive. It's certainly negative if during the execution that things are then going wrong and people are being negative at that point. the only point to be negative, I believe, is at the planning stage. And it's good to be negative because forewarned is forearmed. And it's a pity that smaller businesses are not thinking about that risk and the varied risks, soft risks, and indeed the hard tangible risks up front.
Yeah, sure. I mean, I agree. I think we call it prudence rather than negative to some extent. So, making sure you've got that downside risk covered is for us the important part.
Yeah.
So, anytime where we do get involved with companies that we've been involved in turnarounds, they ask us back to come and see them, help their business planning, chat through. They like us around. They feel that we've helped them. And our focus will be much more around, well, you've thought about the new plan, what you're going to do this year, the new contracts you're going to win, the new people you're going to employ, the new machines you're going to buy. We will be looking at, well, what if that doesn't happen? What if you don't win this contract? What if your new site you open is delayed? What if you don't get... And it's more us saying, well, why don't you just push some of these assumptions through your business plan?
But I even remember myself as a small business owner, and many, many years ago, and I was highly exposed to key customers. So the percentage of revenue from a small handful of customers was just crazy. But of course, you just go along with the flow, and you're not going to say no to a client. But suddenly then, I remember after 9/11 happened, and it just so happened that I was exposed to 3 particular customers, and they all just decided after 9/11, oh, the world is falling apart here. So they just stopped. Because the work that I was doing with them was one of these easy cuts on their cost line. But for me, it was highly significant because 3 key customers. And then when I stood back, and I never let that happen again, by the way, that the percentage of revenue with 1 or 2 customers was just crazy. And that was bad risk management on my part. So lesson learned for me.
Yeah.
So David, tell me about the history of KR8, because it's a fledgling, but you're not a fledgling. You've been around doing this for quite some time. Tell us a bit more about you and how KR8 came to be.
Yeah, so I was a finance director in a business many years ago, and we built that up and eventually sold it. So I also...
What kind of business?
It was retail.
Really?
So yeah, ironically, I was on the finance side, and every year we were raising private equity money, very seasonal business, managing cash flows towards the kind of key Christmas periods, and then you come out of Christmas, reforecast for the year.
Was this non-food?
Non-food, electronics and gadgets, and so I've been on the other side of the table. So I often say when I go and meet directors and finance directors, I have had a period in my career where I was on the other side of the table, and we used to have very difficult conversations on our cash flows going, and especially when you grow in a business and you're trying to grow it quickly, it does consume a lot of cash. I did that, and then I moved into restructuring world in late 2008, start of 2009. Did a couple of years in a bank's restructuring team on secondment for about 18 months, which was good fun because it was just after the financial crisis, and very stressful, but in the same way it was a very good from a experience point of view, and seeing it from the banking side and not just the advisor side. Then we got acquired, so it was a company called MCL that was acquired by Duff & Phelps, and then Duff & Phelps was acquired a company called Kroll, and we eventually rebranded to Kroll. So from 2008-9 through to April last year, I was working in restructuring, and then set up KR8. We launched in January this year. But it's a team probably now of 15 of very experienced restructuring professionals that we've all worked together for a long period of time, and we're very focused on growing the business reasonably rapidly as the market seems to be quite busy. And we've got an office in Manchester. We launch in Leeds next Monday, and we have an office in London as well. And we may well look at other locations. So
what about outside of UK?
We probably won't do anything outside of the UK until we get established and get the team to where we want to be in our plan.
You're not going to come across to my part of the world?
Well, I don't know. I do like Dublin.
Yeah, I bet you do. So, but KR8 is part of a larger entity.
Yeah, very much so. So we're part of the K3 group.
Okay.
We've got about 1,000 employees. We've got corporate finance. We've got transaction services, due diligence. We've got tax, and we've also got disputes and investigations, and we've got valuations. So we're part of a much wider group. So we often work with, especially the transaction services guys, and we've got the tax guys as well. So as we're doing some of the restructuring work, we may call on their skill sets or need their advice as part of the restructuring work we do. So yeah, very much a part of a much bigger and a much wider group.
Okay. So David, when you look back over that stellar career and you're to wave a magic wand, what would you change?
That's a great question. Probably not an awful lot, really. I've really enjoyed the job I've done. I've really enjoyed all the people I've met, all the turnarounds we've done, the team I work with. We've built a great culture in all the businesses that I've worked in. There's been, we've had some really good times, and yeah, I wouldn't really change an awful lot if I'm honest. But you kind of caught me on the hoof there.
That's okay. That's all right, don't worry. But I mean, look, what sounds to me like therefore it's you don't have any regrets, and it's acts of omission rather than commission, perhaps. I mean, you don't regret or you don't want to change anything you could have done or you did do. More about maybe some of the things you might not yet have done, but you're a young man.
Yeah.
So the future for KR8?
Yeah, key for us is to grow. Very keen to get London to a certain size and scale. Spent a lot of time working myself in London. The opportunity is great, and a lot of the clients that we work with, be that private equity, the law firms, credit and debt funds, etc. They're very much based in the London area. So the key for us is to get the right people on the seats. We've got an interview ironically this afternoon with somebody who would be a great fit, and we've got a lot of conversations happening with really, really good talented people that like the idea of almost like a new venture, new brand in the market, being part of something small that's growing quick. So yeah, it's for us, keep an eye on all the markets and try and seize the opportunity that we've got in front of us.
Great, okay. Well, David, let's leave it there. That's been a really fantastic chat. I thoroughly enjoyed it. And for me, there's a few takeaways here. I mean, obviously, as I said at the start, businesses don't intentionally go into distress, but life or shit happens. Whether it be market forces or whether some errors of judgment made internally. But distress can happen, and while you're there to support in distress, but the main message I took from what you said a couple of times is, because you come in with empathy, you come in with great insights, but early intervention to me is the critical piece here.
Yeah, I agree. I think the difference between success and failure in a turnaround, we all need time to deliver that plan and implement the changes needed and speak to the right people and get the stakeholders all involved and aligned in a plan. So without a shadow of a doubt, the key over 15 years of working in turnaround is the earlier we get in, the chances of success are significantly increased if we are there at the early stages of the early warning signs. Sure.
And interestingly, David, but you don't know this, but we have in my company, we've developed what's known as the KR7+ index. It's actually it's an organisation health assessment, and it's like a full body MRI scan for an organisation. And I think it's even interesting because you're coming in and you're reading the numbers. And I know you said you're not only about the numbers, you do once you get in there, but it's the numbers that bring you in. The numbers being in distress are what bring you in the first place through whatever concerned stakeholder. But interestingly, this 7+ index, the organisation health assessment, can actually give that kind of some of that information earlier even. That if an organisation does embrace it, and because then they see the inputs that might be causing the risks down the line. Just an interesting thought. David, let's leave it there. Once again, thank you so much for joining me. I thoroughly enjoy that, and I think there's some great lessons out there for anybody, whether they're currently in distress or even if there's a worry going on in their mind. The message is clear: early intervention.
Thank you, Alan.
Thank you, David. Cheers.